The financial relationship between the United States and China operates beneath layers of geopolitical tension and economic interdependence that few ordinary citizens contemplate in their daily lives. At the foundation of this complex relationship sits a substantial portfolio of American government debt held by Chinese institutions and the Chinese central bank. These Treasury securities represent not merely financial assets, but rather implicit claims on American prosperity and tangible evidence of how deeply the world's two largest economies remain entwined despite their competition. Currently, China maintains approximately $700 billion in United States Treasury securities, a figure that represents roughly 7% of the total Treasury debt held by foreign investors. This amount, while substantial in absolute terms, has declined significantly from its peak of over $1 trillion reached in 2013, reflecting a deliberate diversification strategy pursued by Beijing as it has shifted portions of its foreign exchange reserves toward gold and other alternative assets. Yet, despite this decline from historical highs, China's Treasury holdings remain large enough that meaningful changes in its behavior as a buyer and seller of American government debt could send ripples through financial markets in ways that affect American families thousands of miles from Beijing or Shanghai. The current composition of foreign Treasury holdings reflects shifts in the global financial landscape that would have seemed impossible just 2 decades ago. Japan has emerged as the largest foreign holder of American government debt, maintaining approximately $1.2 trillion in Treasury securities, a position that reflects the Bank of Japan's long-standing efforts to support demand for dollar-denominated assets and the yen-carry trade that encourages Japanese investors to seek higher returns abroad. The United Kingdom ranks second with roughly $900 billion in holdings. China, despite its size and the attention devoted to its Treasury portfolio, now ranks third at roughly $700 billion. When placed in broader context, foreign holdings collectively represent only about 30% of the total Treasury securities outstanding, a percentage that has declined substantially from the mid-2000s when foreign investors held more than half of all publicly traded Treasury debt. The apparent dominance of foreign buyers that characterized the early 2000s has given way to a more diversified ownership structure where American institutions, including the Federal Reserve, pension funds, mutual funds, insurance companies, and household savers, hold the majority of outstanding debt. This fundamental structural shift means that a single foreign holder, even one as large as China, wields less economic leverage over American financial conditions than popular narrative sometimes suggests. The mechanics of how China might reduce its Treasury holdings, should it choose to do so deliberately, reveals both the genuine economic consequences such action could trigger and the practical limitations that constrain China's ability to weaponize its holdings in sustained fashion. If China gradually reduced its Treasury purchases while simultaneously beginning to sell portions of its existing holdings, the initial market impact would depend heavily on the pace and scale of such activity. Gradual selling might barely register in daily market moves because the Treasury market processes roughly $500 to $600 billion in transactions daily and functions with sufficient depth that even substantial individual positions typically filter into the market without creating acute disruption. The real economic impact would emerge not from panic, but from the price adjustments necessary to attract alternative buyers willing to absorb the supply of securities no longer being purchased by Chinese entities. Rising yields on Treasury securities represent the price mechanism through which financial markets clear supply and demand imbalances. If demand from China declined, yields would need to rise high enough to attract other investors, whether from Japan, Europe, pension funds, insurance companies, or American households, to purchase the securities China no longer wanted. This sequence of events creates the actual transmission mechanism through which geopolitical tensions surrounding Treasury holdings translate into consequences for ordinary Americans. The 10-year Treasury bond yield serves as the benchmark interest rate for the entire American mortgage market. When Treasury yields rise, mortgage rates rise correspondingly, typically tracking within a spread of 1.5 to 2 percentage points. A household considering a home purchase experiences the consequences directly and immediately when yields on 10-year Treasuries climb even 50 basis points, because that movement typically translates into roughly half a percentage point increase in the mortgage rate offered. For a family financing a median-priced home through a 30-year fixed-rate mortgage, such an increase in the borrowing rate translates directly into thousands of additional dollars in interest paid over the life of the loan. Higher Treasury yields also cascade through other financial markets affecting automobile loans, business borrowing costs, credit card rates, and any other consumer or business borrowing tied to benchmark interest rates. A broader economic slowdown would likely follow because businesses would delay expansion projects when their cost of capital increases, and consumers would defer major purchases that depend on consumer credit. Employment growth would probably decelerate as businesses responded to reduced demand and higher borrowing costs by hiring fewer workers or cutting positions. This sequence of economic consequences, from Chinese selling to rising yields to higher borrowing costs to economic slowdown, would unfold not as sudden crisis, but as gradual, almost invisible erosion of economic activity. The practical reality of China's position as a Treasury holder, however, introduces important complications to this chain of reasoning that are frequently overlooked in popular discussions of the subject. While China could theoretically reduce its Treasury holdings, doing so would have material consequences for China's own financial interests and stability. China maintains approximately $3.3 trillion in total foreign exchange reserves, a war chest accumulated through decades of trade surpluses and careful financial management. The composition of these reserves matters enormously for China's central bank and government because the returns generated on these reserves flow back into the Chinese government's budget and contribute to Chinese fiscal capacity. If China were to sell substantial quantities of Treasury securities, the action would drive down their prices and reduce the value of the remaining holdings it chose to retain. A fire sale of Treasury holdings at a time when China might need liquidity would generate losses that China would bear directly. Furthermore, selling Treasuries aggressively would likely weaken the value of the dollar relative to the yuan, a development that would make Chinese exports more expensive and less competitive internationally, precisely the opposite outcome Beijing would want if it were attempting to support Chinese export industries. The supposed leverage China holds through its Treasury position operates more as a mutual destruction principle than as clear strategic advantage, because using that leverage would harm China as much as or more than it would harm the United States. Evidence from actual market behavior over recent years suggests that when Chinese holdings of Treasuries have fluctuated or declined, markets have adapted without requiring dramatic adjustments. China's Treasury holdings have drifted downward for over a decade as Chinese policymakers have gradually shifted allocation toward gold and alternative assets. Rather than generating crisis conditions in American financial markets, this slow reorientation has been absorbed through gradually rising yields that have attracted compensating demand from other sources. Japanese investors, despite concerns raised about their own fiscal situation at home, have actually increased their Treasury holdings as yields have become more attractive. European investors, Gulf state sovereign wealth funds, pension funds, insurance companies, and mutual funds throughout the developed world have all stepped into markets to purchase Treasuries at higher yield levels. When the Federal Reserve ended its quantitative easing programs and eventually entered a period of quantitative tightening where it sold securities from its balance sheet, markets absorbed these sales without disruption because alternative buyers were willing to hold Treasuries at higher yields. This adaptability reflects the unique position Treasury securities occupy in global finance as the most liquid, most tradable, and most reliably safe investment vehicle available to international investors. The apparent crisis scenario depends on a disruption of such magnitude and velocity that alternative buyers could not step into markets in orderly fashion. This scenario would require either China selling vast quantities of Treasuries in compressed timeframes or a coordinated decision by multiple major holders to simultaneously divest from dollar assets. The first scenario seems implausible because China would face its own financial consequences, and because markets can absorb very substantial supply increases given sufficient time for yields to adjust. The second scenario assumes a level of coordination among countries with competing interests that seems equally implausible in practice. Japan's immediate interests, for example, would be served by maintaining a strong dollar and stable Treasury markets, since Japan exports heavily to the United States and holds enormous Treasury positions. Europe's interests in maintaining financial stability point in similar directions. Even if geopolitical tensions between the United States and China escalated significantly, the interconnected nature of global financial markets means that any attempt by China to weaponize its Treasury holdings would likely trigger responses from other actors, including aggressive Federal Reserve intervention if markets showed signs of becoming disorderly. The Federal Reserve possesses substantial tools for managing Treasury market stress should it emerge. During periods of extreme market dysfunction in past episodes, the Fed has implemented various interventions, including purchases of Treasury securities, expansion of its balance sheet, and adjustments to its policy rates designed to ease market function. While the Fed cannot directly prevent markets from operating through price mechanisms, it can ensure that sufficient liquidity exists, that prices adjust orderly rather than experiencing panic dynamics. The Fed's capacity to implement emergency operations means that even in scenarios involving substantial shifts in foreign holdings of Treasuries, authorities retain ability to prevent cascading financial instability. This backstop role of the Federal Reserve fundamentally limits the damage that any single foreign holder or even coordinated groups of foreign holders could inflict through aggressive selling strategies. The real economic challenges facing America's fiscal position do not stem from China's Treasury holdings, but rather from structural features of American government finances that would persist regardless of foreign investor behavior. The United States government runs persistent, large budget deficits funded through Treasury issuance. The trajectory of federal debt relative to the economy's productive capacity has been rising for years and is projected to continue on that path for the foreseeable future. These realities mean that rising interest rates and higher Treasury yields likely lie in America's future simply as a consequence of increased supply of government debt needing to be financed. Whether that supply is purchased by China or by domestic investors or by Japanese pension funds matters less than the underlying fact that the quantity of debt has grown relative to the economy's size and therefore requires higher interest rates to attract sufficient buyer demand. In this environment, geopolitical tensions between the United States and China over Treasury holdings function more as a complicating factor than as the primary driver of financial conditions. The real leverage over American economic conditions flows from the structural reality of large deficits requiring ongoing financing rather than from any single country's decisions about how much Treasury debt to hold. Understanding the Treasury market ecosystem correctly requires abandoning the notion that China holds some sort of financial sword hanging over America's economic head. China's Treasury holdings do matter to financial market dynamics and to the geopolitical relationship between the two nations, yet they matter in more constrained ways than sensational headlines sometimes suggest. If China gradually reduced its Treasury purchases or modestly increased selling from its existing portfolio, the adjustment would most likely involve higher Treasury yields that eventually attract compensating demand from other investors. If China attempted aggressive selling in compressed timeframes, it would face its own financial consequences that would constrain the strategy's scale. If China coordinated with other nations in some sort of Treasury boycott, the political and economic costs of such coordination would likely exceed any benefits. The genuine vulnerability facing the American financial system flows not from China's holdings, but from the structural fiscal position of the government and the unprecedented scale of Treasury issuance required to finance ongoing deficits. A household considering a home purchase, a small business planning expansion, or an investor planning retirement will face higher borrowing costs and lower investment returns in coming years, not because of China's Treasury strategy, but because the United States has committed itself to spending patterns that exceed its revenues and that require increasing levels of government borrowing. That underlying reality, rather than any foreign holder's portfolio decisions, represents the true challenge to American economic prosperity.